Canada just added 67,000 jobs in October. Unemployment dropped to 6.9%, and wages are up 3.5% year over year. All sounds good on paper, right? But the reality is not so good, because when you dig into the details, this report actually tells a very different story. One that explains why the economy feels worse even when the numbers look better, and why the housing market could be heading into an even weirder phase. Full-time hiring actually stalled. Construction jobs fell by 15,000, meaning the sector that builds homes is still shrinking. Total hours worked across the economy actually went down because of strikes and weak demand. And even with all of these new jobs, 27.7% of Canadians still say they're struggling to afford basic needs like housing, food, and transportation. So we're technically creating jobs, but not wealth. And this is the difference between a recovery and a recession in disguise. Because in Canada, we're not in an economy that's booming. It's an economy that is just barely hanging on. And employment numbers can look strong one month, but they are masking a much deeper, fragile nature of Canada's economy. Here's what this really means for Canada and for housing. The unemployment rate dropped from 7.1% to 6.9%, the first decline since winter of last year. This is technically good news, but only if you ignore the fine print. Most of those new jobs created were part-time, up 85,000 part-time jobs, while full-time employment barely moved. So this is like saying more people are working without asking how many hours they actually work or what kind of pay they're getting. So we create 85,000 jobs, but if they're part-time and they're working half the hours, it's really only half of that from a perspective of how much this actually contributes to people's household finances. In Canada, we're seeing a huge increase in people who are working multiple jobs. So a lot of these part-time jobs might not actually be new jobs from people who were unemployed, but people who are actually working more than one job. The number of people in the US is almost back at a record high of people having to work multiple jobs. And so this is why part-time job creation scares me quite a bit, is if we're approaching that like level of disparity where so many people need to work multiple jobs just to get by. In Canada, we now have 1.15 million people holding multiple jobs. The other interesting piece from this is that 1 in 3 workers added were people over 55 years of age. So either young people are being disproportionately excluded from the workforce, or we're seeing people who are retirement age. And maybe, I mean, during COVID, we heard this big theme of people taking an early retirement or like speeding up their retirement plans. And now I think what happened during that period of time is a lot of older people are realizing the cost of living is crazy and that they're probably not going to be, maybe they were optimistic about their retirement planning and they're actually going back to work, maybe taking a part-time job or whatever to subsidize their retirement a little bit and doing like the semi-retired thing. This distinction between part-time and full-time work matters a lot because the total hours worked fell 0.2%. And what this tells me is that, setting aside the labor disputes and strikes, if our number of jobs is going up, but the total number of hours being worked is shrinking, then that means that the money changing hands from the market to the labor is shrinking. And all of those jobs that are being added are actually net contraction if, again, we're adding more part-time jobs, but fewer hours in total. So you can't have higher productivity or real growth if people are working less. So this jobs recovery is more about classification than actual growth or prosperity. And the labor market isn't heating up as we might want to say. This is why a lot of people were saying it was surprising to economists. The Bank of Canada is in a tough position because it looks like this is a positive economic indicator, but we're really just relabeling what work looks like. And I don't think the Bank of Canada actually is concerned about this looking too positive on the economy, because they can read past the headline and say, oh, well, those are mostly part-time jobs. If anything, that's actually a worse indicator of the economy, because businesses aren't creating full-time jobs, they're creating part-time jobs. And employees aren't getting full-time jobs, they're getting part-time jobs. And that's what's shrinking the unemployment rate. So if we were to actually call it what it is, you always wanted to jump between unemployment rate and the employment level, because our denominator was changing, the number of people in the workforce, because you had population growth on the way up and now you have population contraction on the way down. Your employment level is actually maybe a clearer indicator than your unemployment rate. Similarly, You almost want to start looking more at hours worked now as a complementary data point compared to employment level or unemployment, because the composition of these jobs is really worth paying attention to. If we're adding tons of jobs, but they're all part-time, it's not really that much growth. Now, here's where it gets a little bit more important for housing. Construction employment dropped by 15,000 jobs in October, and that's now down almost 40,000 since January. Now, obviously, all job information is important for housing. If people lose their jobs, they're more likely to have to sell their house from financial stress. If people lose their jobs, then they're less likely to buy a house. And so it can attack both your demand and supply side of the resale market at the same time. But construction unemployment tells me what's happening in that market. This is happening while the federal government is promising record housing starts and municipal approvals. You can't build homes if the people who build them are losing work. This is what economists might call a structural slowdown, where the foundation of growth starts to crack even while the surface indicators look fine. Add in weak manufacturing, higher financing costs for developers, and we're looking at a housing pipeline that could keep shrinking. And so you can see here that CMHC actually forecasts that housing starts are going to fall for the next 3 years. Most of the job gains came from men aged 25 to 54, young Canadians aged 15 to 24, which is nice. Youth employment has been a huge concern for me. And so youth employment rose by 80 basis points, or almost 1%, but that barely dents the 14.1% youth unemployment rate, which is still near a 15-year high. That means a whole generation is entering the workforce late, they're underemployed, and they're likely priced out of homeownership. And this does not really set the stage for a housing recovery that we're going to desperately need whenever this whole economic storm actually gets weathered in the next couple of years. It's more of a demographic drag than a recovery. Now, in a rare Ontario win, most of the new jobs actually came from Ontario, up 55,000, bringing their unemployment rate to 7.6%. But your context still matters here. As I covered in my last take on employment, you're still seeing a big drag on the auto sectors. Windsor's unemployment still at 9.6%, and Southern Ontario's manufacturing regions are barely recovering from the trade shocks earlier this year, and probably won't until we get some sort of resolution, maybe the trade agreement for Canada-USMCA. I mean, this is one of those things that's just going to keep being turbulent and a headwind and a headache and scary, and it's going to prevent people from buying houses, and it's going to force people to sell houses. The GTA's service sector is holding up a little bit, but the goods producing economy, the ones that build stuff and exports it and transports it, is starting to soften. Here's the part in StatCan's research or release that really stood out to me, and it really exposes what Canadians are feeling. StatCan says that 27.7% of households are struggling to afford basic needs. And for renters, that's 37%. For owners, it's 24%. And that's despite falling inflation and increasing wage growth and GDP growth and whatever. To me, this is proof that high rates, high costs, and weak wage growth are squeezing households even during this so-called recovery or not a recession. It doesn't matter how many jobs you add, the economy isn't working for them. So what does this all mean for housing? To me, it's pretty simple. Without income growth, it doesn't create new buyers. Construction job losses may mean fewer homes, and financial stress keeps renters from saving for down payments. All of this combined is a cocktail for stagnation. Lower sales, softer rents, developers delaying projects until confidence returns. So yes, the unemployment rate went down, but until we see strong, full-time, productive job growth, especially in construction, this economy is still living on a month-to-month, paycheck-to-paycheck basis. These construction job losses are even ahead of the winter layoff season. Like, you get a lot of the trades just take, however many months off during the winter if you're working in a trade that can't be done, like infrastructure or whatever, where it's frost limited. So all in all, my take on the most recent job print looks positive on a headline basis, but when you dive into it a little bit more, it's probably not all that good. And I think the Bank of Canada still has more runway to cut here. I think they probably will cut in December. I'm still of the opinion that when Q3 data comes out, we might actually see our second quarter of consecutive GDP contraction. We'll actually be in a recession. And policymakers and the central bank will actually have runway to behave as if it's in a recession. But right now they're kind of behaving in that way, but they don't really want to admit it because they don't want to sound the alarm. I think we will have at some point 2 consecutive quarters of negative GDP growth. I'm surprised we haven't yet. I think probably Q2 and Q3 combined might get us there. If not, we might see, Q2 down and then Q3 up and then Q4 down. And that kind of gets you back to like your 1990s. I actually didn't think we would see this, where you saw this kind of like long, it wasn't like a super deep recession, but it was a really long one. That sucks. That's really hard. You'd almost want this like deep recession and bounce right out of it really quickly. Like deep recession, cut rates, emergency, everything, policy, huge deficit, central bank, negative interest rate policy, quantitative easing, and then they start ripping the economy out of it. But as it stands right now, we don't have that. And so you're sort of stuck in this slow grind down that everybody is feeling it, especially on a GDP per capita basis. I mean, I see all of you in my comments saying we've been in a recession for the last 2 years. And again, technically not correct, but I agree with you. And I think each individual does feel like they've been in a recession for the last 2 years because GDP per capita has fallen. So let me know your thoughts. Do you think Bank of Canada is going to cut in December? Do you think this job print changes their outlook? Is there anything I missed here that I should have mentioned? And just generally let me know your thoughts in the comment. Thanks a lot for taking the time to watch this video. It means a lot to me that you would take the time out of your day. And I'll see you again as soon as I can. I got a couple more cool videos coming. One on the birth rate and housing impact on the birth rate. Some new research that just came out from an economist at U of T. And another one on international students and how we're going to see a 50% reduction in the international student population and how this will impact different housing markets across the country.